You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Welcome back to the Deep Dive, where we take the fire hose of information and distill it down to the essential, surprising, and truly actionable insights you need. If you own a business, or you're even thinking about it one day, you know that understanding what it's worth is, well, it's foundational. But what's that really mean in practice?
It means we are tackling the ultimate objective reality check today, enterprise value. And this is so essential because, look, most owners have a feeling about what their company is worth.
Oh yeah, a very strong feeling, usually.
A very strong feeling, but that feeling, it almost never aligns with the cold, hard numbers an objective market provides.
And that's really the core mission today, isn't it? We're looking at why an independent professional business valuation isn't just a document you get when you're ready to sell. It's the critical starting point for every piece of long-term strategic planning. It's really the diagnostic tool for growth.
And like you said, it's often a necessary intervention. So many owners hold on to years of unchallenged, maybe even inflated expectations about their business's worth. A proper valuation grounds everything in reality.
We've got some excellent detailed insights for this deep dive from the Shaughnessy Group, and they lay out the essential reasons why every business owner needs this. It doesn't matter if you're a scrappy startup or a decades-old manufacturer.
Absolutely. Understanding that number is power. We're going to explore why this objective assessment is necessary, not only for those big, unavoidable transitions, but, maybe more importantly, for maximizing your day-to-day strategic growth.
Okay, let's unpack this. Before we get into the 9 key reasons, we really have to clarify what we mean by enterprise value and what makes a professional valuation different from, say, my quick back-of-the-envelope calculation.
Right. So enterprise value, or EV, is the total economic value of a company. It's not just the equity value. It includes the debt, the liabilities, and crucially, the cash on hand. It represents what an independent buyer would pay for the entire operating business, free and clear of debt, to take over the whole thing as a going concern.
So if I just look at my balance sheet and multiply my net income by some industry average, that's not it.
That is absolutely not it. A professional valuation is really defined by 2 things: independence and rigor. It's done by a professional third party who dives deep into every part of your business.
Every part.
Everything. Your internal financials, assets, liabilities, depreciation. But then, and this is key, they combine that with a really exhaustive inspection of external factors: the current market, your competitors, broader industry trends.
Wow, that seems like a massive undertaking. So when they're doing that analysis, what's the difference between, valuing a tech company versus valuing a heavy manufacturing plant? The assets are completely different.
And that's exactly where the rigor comes in. They don't just rely on one approach. The professional applies different, recognized methodologies based on what makes sense for that specific business.
What's really fascinating here is that the source stresses that ideally you should use more than one valuation methodology. Why is that so vital?
It just provides the clearest possible picture. It's essential for due diligence. Think of it this way. If you have a manufacturing plant with a lot of land and machinery, an asset-based approach might give you a pretty high number.
Makes sense. Tangible assets mean tangible value.
Right. But now what if you have a software as a service company, a SaaS company? It has almost no tangible assets, but it has incredibly high recurring revenue and growth potential.
So an asset-based approach would value it at basically 0.
Close to it. For that, you need an income-based approach, which focuses on future cash flow, or a market-based approach, which compares it to similar companies that have recently sold.
I see. So using multiple methods, make sure you don't undervalue the SaaS firm, but you also don't overvalue the factory if its machinery is obsolete. It gives everyone, partners, buyers, investors, a clear, multifaceted picture.
Precisely. It mitigates the risk of relying on a single, potentially skewed data point.
Now that we know what it is, let's shift from the how to the why. The crucial, high-stakes life events where this knowledge is just non-negotiable. And the first one is, it's highly personal and unfortunately very common: divorce.
Yeah, this is often the most emotionally charged scenario. When a business is built or grows significantly during a marriage, it's considered a marital asset. When the marriage ends, the courts need a fair distribution.
And the business owner is almost always biased here. They're either overstating the value to a partner they're trying to buy out,
Or
or...
grossly understating it to the court to minimize the final settlement.
Exactly.
So without an unbiased professional valuation, how can a court or either person ensure an equitable division?
They can't. And this valuation, it doesn't just calculate a number. It can save those parties hundreds of thousands of dollars in, ruinous, prolonged litigation because it anchors the whole discussion in an objective, legally defensible reality. It brings clarity. Moving on to reason 2. Selling a business. This seems obvious, but what's the real difference in the outcome between a seller who uses a broker's estimate versus one who gets a full professional valuation?
The difference is confidence and realism. A valuation gives you a clear, objective assessment of the business's market value based on its current condition and future potential. A broker's estimate, while it can be helpful for marketing, might lack that deep financial review that sophisticated buyers demand.
So the professional valuation sets a realistic asking price. And that's critical, right? You ask for a price that's too high based on some dream number, what happens?
Buyers walk away, your listing goes stale, and if you eventually drop the price, you just look desperate. By starting with a professional valuation, you enter negotiations with confidence, and, just as important, it gives the buyer confidence.
No, that's a good point.
They know the value is third-party assessed, it streamlines their due diligence, and it's usually required by lenders for financing anyway.
Then there's transition planning, the inevitable exit. Everyone leaves their business eventually, one way or another.
And the valuation is that necessary baseline. It answers the question, if I walked away today, what is my enterprise worth? But here's where it gets strategic. It shows you the gaps between what you have now and what you need for your post-exit goals.
You can't plan to cross a chasm if you don't know how wide it is. What's a typical gap the valuation exposes?
Oh, often it's reliance on the owner. The valuation will expose what we call key person risk, the fact that the owner is responsible for 70% of the sales pipeline, for instance.
Right.
Or it exposes a lack of high-quality recurring revenue. The owner suddenly realizes they need to spend the next 5 years restructuring the business to fill that financial gap and build value that's separate from them.
That is a powerful motivator. And often these valuations are needed for internal changes too, right? Like partner and management buyouts.
Yes. Reason 4 covers that internal divestiture. The first scenario is pretty simple. Buying out a partner. If one owner decides to leave, the remaining partners need a professional to determine the fair value. It avoids accusations of lowballing.
And the second is the management buyout, the MBO.
Correct. When the older generation of owners divests to the remaining management team, that team, who often knows the business better than anyone, still needs an external professional valuation. It ensures the transfer is fair and lets the transitioning owners properly plan their estate.
Now, let's shift gears. We've been talking about necessity sort of reactive scenarios like divorce or a sale. Here's where it gets really interesting because a valuation isn't just about leaving. It's about going on offense. It's about strategic growth.
That's reason 5, strategic planning. Running a business is exhausting. Owners get tunnel vision, focused on delivery. A professional valuation forces you to look at the business from a buyer's perspective.
Which would uncover what?
Inefficiencies. Opportunities for growth you might otherwise miss. It's the ultimate efficiency check.
Can you give me an example of how that valuation document turns into a strategic roadmap?
Certainly. The valuation process identifies your specific value drivers. For instance, the analysis might show that one of your product lines has a 45% margin, while another is only 12%, but you're giving them equal resources.
Oh. Yeah.
The roadmap is clear. Eliminate the low-margin distraction, or push hard into the high-margin market. It identifies ways to grow revenue or, just as important, areas to cut unnecessary costs, often hidden in bloated inventory or underutilized equipment.
So it gives you a clear path to operate more efficiently before some event forces your hand.
Exactly. It quantifies what you need to fix to increase the enterprise value.
And when a business starts executing on that and becomes successful, it attracts attention. Which brings us to reason 6. Attracting equity investment.
Successful companies draw the attention of sophisticated capital. Private equity, family offices, angel investors. When those serious investors come calling, they need assurance their money is going into a stable, well-understood entity.
So for a sophisticated investor, a professional valuation is basically a shortcut to due diligence.
It is. A recent valuation offers them a complete, verified snapshot of the business, its financial health, its structure, and its future earning potential. It provides the objective data they need to justify their investment to their own stakeholders.
Right.
Without it, the negotiation can turn into this protracted, frustrating back and forth about assumptions instead of facts.
And speaking of financing, let's talk about growth financing itself. Reason 7. Whether you need funding for new equipment, a remodel, or just bridging a payroll gap, lenders need this objectivity too.
Lenders are risk-averse. When you present them with a professional business valuation with detailed financials verified by a third party, you are de-risking the loan from their perspective. It helps streamline the whole process.
The next one, reason 8, is often overlooked until it's way too late.
Yeah.
Value protection and insurance.
This is pure risk mitigation. If you don't know your business's true, professionally assessed worth, you are likely severely underinsured. The detailed valuation helps you determine the proper amount of coverage you actually need.
So if a natural disaster wipes out your key assets, or you need to calculate business interruption insurance, having that official number is everything.
It is, because it dictates the payout. It ensures you can rebuild quickly. It also influences payouts for things like co-owner life insurance agreements, key person insurance. So the business has the capital to buy out an owner's shares upon their death.
It keeps the business from being crippled by a sudden liquidity crisis.
Exactly.
And finally, let's discuss reason 9, estate planning. This addresses the big what-if scenario and is all about protecting your legacy.
It absolutely is. You need a legally sound, financially actionable plan to protect the company's future if something happens to you unexpectedly. This means deciding who would run the business, a family member, a partner, a key employee, and how that transfer is structured.
And I assume having a recent business valuation with up-to-date financial records is the mechanism that helps that designated person get the estate in order quickly and cleanly.
It is. It minimizes disruption, ensures tax compliance, and guarantees the transfer of wealth is executed according to your wishes, protecting everything you built.
If we connect this to the bigger picture, the theme here is really preparedness and vigilance. It's like monitoring your personal health. Protecting and growing your business requires you to be proactive.
Yes, and understanding the risks in your business and, most importantly, identifying the key drivers of its valuation that guides all of your strategic planning.
The true value here, beyond any single transaction, seems to be getting that independent third-party assessment at regular intervals. It's the core mechanism for both protecting and actively growing the enterprise value of your business.
It really is. It transforms the owner from a passive manager into an active value architect.
And this raises an important question, something for you to think about. Beyond the raw numbers of assets and earnings, how do you even begin valuing the intangible assets?
Things like customer loyalty, brand reputation, proprietary processes, your team's talent. And what's the fundamental difference in practice between the objective value from the analysis and the final price a buyer is willing to pay?
Those are the concepts that really drive the complexity and strategic power of a professional valuation in today's economy.
Something for you to ponder as you look at your own business.
That is a perfect note to end on. Thank you so much for taking this deep dive with us today.
And we'd like to express our gratitude to the Shaughnessy Group for providing these essential and insightful details on why a professional business valuation is so critical for success.
If you're looking to explore these concepts further, including how to best prepare for evaluation, a deeper look at specific methodologies and common mistakes to avoid, we really encourage you to visit their website.
You can find those resources by visiting shaughnessy.group. That's SHAUGHNESSY.group.
We'll catch you next time for another deep dive.
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.